Mid-cap ITs, where the traction is. You just heard from the management of Exaware that they're confident of maintaining a 20% plus revenue growth. And Firstsource also came out with impressive set of numbers. For last 2 years, Firstsource has gone through a major process of restructuring. But if I analyze the numbers, what they've reported for the quarter gone by, I think the real top line stroke revenue growth is back. So what has done the trick for the company for the quarter gone by? Let's connect with the management. Mr. Rajesh Subramaniam, Managing Director and Chief Executive Officer of Firstsource. Rajesh, morning. Thank you for joining us. Now, for the quarter gone by, the revenue growth was very impressive. For the quarter gone by, you've reported a revenue uptick of about 8.6%. Do you think genuine growth is now back for Firstsource?
Yeah, I think our growth year on year has shown a remarkable improvement at 30% and quarter on quarter at 8.6%. It's on the back of increased volumes and on the back of new deals that we signed. If you recollect, in Q3 last year, we announced that we had signed up to $160 million of total contract value in deals, and those are playing themselves out as we speak. These contracts are still not at their optimum level of growth, and they will get to their optimum level of growth over the ensuing quarters. So the growth trajectory that we are seeing is heartening, and we continue to build momentum on our revenues.
Rajesh, the last time when we spoke, you mentioned that you expect higher revenue growth and improvements in the operating margins as well in FY13. Do you still hold that view?
No, actually, as I've gone on record, the worst of our financial performance is over as of Q3. From Q4, you would have seen our margins trending up. In Q1, if you see our operating profit and our profit after tax, our operating profit has grown by 60% year on year, and our profit after tax has grown by about 170%. We've taken significant cost optimization exercises. We have driven several levels of efficiency at various engines of growth in the business. And from a margin perspective, if you take a look at my operating profit, which gives you the measure of the operating health of the company, between Q4 and Q1, we have maintained it at the same level. Q4 is typically our best quarter because we have elements of seasonality both in our collections business and healthcare provider business that gives us an uplift in both revenues and profits. Both of them fall off in Q1. Plus, we have the wage hike cycle for our agents in Q1. So despite the seasonality fall off and increase in salary costs for my agent population, we have maintained our operating EBIT at 5%, and that signifies the turnaround in the company's performance.
Rajesh, how is the deal pipeline looking? For the quarter gone by, have you won any significant deals?
Our pipeline is extremely robust. Our pipeline across healthcare payer, across our UK and US customer management business, in our domestic business are extremely robust. We have had healthy wins this quarter, which will again translate into growth going in the ensuing quarters. The NASSCOM projection for growth is 11 to 14%, and given the momentum we are seeing, we believe we would be somewhere at the higher end of that projection as we end fiscal 13.
You also have outstanding FCCBs to the tune of about $170 million. How hopeful are you of meeting this commitment by December?
Several strategies are being pursued. We are in conversation with lenders, we are in conversation with our stakeholders, we are evaluating several strategies to augment our cash. We have a repayment of $237 million coming up in December. The environment is not as easy as it was a couple of quarters back because a depreciating rupee increases the liability that I need to fix. So it's not as easy as it sounds, but all I can tell you is that we have actions in place that will hopefully take us across the line in December.
All right, Rajesh, appreciate your time and good luck for coming quarters. The countdown has started.